Welcome back to the Eric Krown crypto channel and continuing with the options beginners playlist series here. Today we'll be focusing on the Greeks, starting with deltas. So what is delta in colloquial terms? It is essentially what you make on a per dollar basis for every $1 change in price action. Now I will bring up the Investopedia definition over here. And I think that may or may not be helpful for people. I know for myself, I usually just do better by, experiencing it myself. But if you want the dictionary definition, here it is. Delta is a risk metric that estimates the change in price of a derivative, such as an options contract, given a $1 change in its underlying security. The delta also tells options traders the hedging ratio to become delta neutral. A third interpretation of an options delta is the probability that it will finish in the money. So let's address that. I think that last point is actually the most interesting, in fact. And what you'll notice over here on the options bingo board, if we were to look at, let's actually go to the weeklies here, we can see the deltas for each and every strike. And the delta is basically a probabilistic standpoint as to how likely that option is to end up in the money. So you can see right here, the $5,000 call strike, 100 delta. Extremely likely to end in the money. Basically, the market makers are telling you it's 100% right now. The $10,000 strike, again, 100 delta, 100 delta, 100 delta, 100 delta, all the way up until 17,000 actually, which is 99 delta. So basically, you can read that as 99%. Same thing with 17,500. You start to see it really drop off after that until we get to the at the money strikes, which should be around 50 delta, basically. Currently, Bitcoin is trading 22,700. So what is the current at the money strike? Well, it's actually split in the middle here between 22.5 and 23,000 bucks. It's literally 22,750 right now. So that quite literally is like right in between them. But you'll notice for the deltas here, let me actually pull it back up. Okay, there we go. Yes, just making sure I'm on the right pane. You'll notice that the $22,500 call strike delta will be 0.57. So that's 57 delta. So basically a 50-50 chance right now. $23,000 call strike is 47 delta, or 47% probability that or likelihood that it does close within the money. And of course, the further that we go out of the money here, the more and more likely that it is going to not be in the money, thus have a lower probability. And here's the thing. The deltas, if you're looking at the call side over here, will always go from high to low, from when you're starting from a lower strike to a higher strike, and vice versa for puts, naturally speaking. And of course, the further out that we go, the closer and closer to zero that we do get, until in this case, it's like saying 0% probability of $32,000 basically by next week. Fair enough. I probably agree with that, personally speaking. But even 30,000 has a 1% probability, 1% chance right there, according to this. So another way to be looking at deltas is this. When you own a long option call, basically, so you're long one option, or sorry, you're long one call, that options delta upon expiration will only ever be, this is a hard rule, only ever be either 100 or 1 or 0. It's either in the money or out. There is no in between upon expiration. It is either worth something or worth less, meaning worth nothing. And so as we do get closer to expiration, you'll look at something like this. So this expiration over here is only 15 minutes away, and you'll notice that everything that is, of course, everything that is below the current at the money strike is basically going to be 100 delta. They're all going to be 100 right here, and everything above is, which is $23,000 call strike, is going to be 0. They will all be out of the money, all worthless. So another way that you can also interpret deltas is you will be shown over here. I don't have this right now because I do not have an account, as Americans are not allowed to trade on ByBit. But if I did have an account and I did have a position on, there would be a pane where my cursor currently is, representing my current positional deltas. That is what I alluded to at the beginning of this video, meaning that the number that you'll see right here will represent your P&L change for every $1 change in price action. So if I had 100 deltas right here, then that means for every time that Bitcoin goes up $100, I make $100. And every time that Bitcoin goes down $1, I lose $100. That number probably changes over time as well, but that is a very easy way to kind of gauge where your positional risk is for your whole position on this asset. So if it was 50 delta, then that means that for every $1 that price action goes up, I make $50. And if for every $1 that price action goes down, I lose $50 as well. Very quick and easy way to kind of gauge where you're at within the market. Other than that, as I reference this definition over here as well, you can look at the deltas on the actual options pane itself as a means of obtaining the deltas that you see over here. So when you buy, let's say that we go over to this next expiration, 25th of July, so that's tomorrow. This video is being recorded on the 24th. And we wanted to get more long deltas, meaning that we wanted to have, we wanted our P&L to go up as pricing goes up. Well, one way of doing that would be we could just buy the deltas over here in this pane where you see the delta number. Every time that I buy one of these, well, that will be added on to my portfolio delta that we were just looking at the top of the pane. And so if I bought one of these $22,000 call strikes, it would give me spot 83 deltas for every long deltas, I should say, for every contract that I buy. So if I buy one, I get 83. If I buy two, I get 2 times that, so on and so forth. You get the idea. The reason why that's important, though, is because you can quickly and easily change around your portfolio delta with that sort of an understanding. You can say, hey, I want to have more long deltas here. Here's what I want to position around. And, well, it'll basically show right there. So, again, the key points here, upon expiration, an option contract either is 100 delta or 0 delta. It's either in the money or out of the money. There is no in between, or 1 delta or 0 delta, depending upon whether you're thinking in American or European terms. In this case, European, obviously, so 1 versus 0. The delta on the actual options expiration dates over here also represents the probability that it ends up within the money or not. 1 delta being 100%, 0 delta being 0% is the current trajectory. And what else can we say about this? Well, as we go back into the Investopedia dictionary definition, well, gives you a bit of an insight on the hedging ratio. Again, that is just another way of saying what I was representing over here. When you're looking at your deltas for your portfolio for all of your positions, you get a quick snapshot as to where you kind of want price action to go. If you're long deltas, you want price action to go up. If you're short deltas, you want price action to go down. With that said, I think that'll handle it for this particular video. Treat your deltas well and they will treat you well, but they are not the full picture. We want to also be looking at gammas, vegas, theta, and theta as well. Those are going to represent all of the Greeks, but deltas are like the first defense when kind of understanding where your positional risk is. I'll see you in the next one. Take care.